Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is author and investor Brendan Hughes. Brendan wrote a very interesting book entitled Markets in Chaos, where he analyzed various boom and bust cycles that have happened over history. Brendan is also on the investment team at Lafayette Investments, a Maryland-based RIA. In this wide-ranging discussion, we covered the major lessons he learned from writing Markets in Chaos, Lafayette's approach to security selection, how he and his firm define a quality company, similarities and differences between today and the 1970s U.S. energy crisis, and why he has a strong distaste for the value and growth labels that get placed on investment strategies. Brendan mentioned several securities on this podcast. The only one I own is Berkshire Hathaway. And without any further ado, here's my conversation with author and investor, Brendan Hughes. Like some of the other people who we've had on this podcast, you were both an author and an investor. I'm curious about how similar the research process associated with writing books is to the research you do on individual companies.
I think it's there's a lot of similarities, but I would like to note what I think are a couple important differences. When doing research for the writing of a book, I'm looking through the lens of how can I explain this subject to someone else, which is that's a pretty different viewpoint than if you're just looking to research a company where you're trying to figure out, is this a good investment? So it is a different context. And another important difference between the two is that when you're writing or when you're researching for the writing of a book, you're also looking for interesting tidbits. For example, like if in my book, Markets in Chaos, I used different tidbits like referencing what people did at a specific point in time, such as interesting facts about hyperinflation. Well, those types of things are not going to be relevant to research on individual companies, because it's not going to matter, say, like a specific fact in 1990. That's not really going to make any difference as to whether it's a good investment or not. So I think that those are some key differences. But outside of those things, a lot of things are pretty similar.
And you mentioned the book Markets in Chaos. You did a lot of work to try to understand cycles and, kind of like, major ups and down phases in market history. I'm curious about how that knowledge you gained about boom and bust cycles influences how you invest today.
Yeah. Thanks for the question. My motivation for writing the book actually came about after the COVID-19 crisis. I was reflecting back on that time. I was thinking, like, how could I have been better prepared for this period? Because all the people, or a lot of the commentators on TV, kept saying that this was some unprecedented event, and not to take away from the negative things that happened, but this was not some unprecedented event. We've had various similar events that were more impactful in history. A few that were referenced were the Spanish flu in 1918 and the Black Death in the mid 1300s. And so the more I've studied history, the more I'm able to get comfortable with saying, we've seen this before, and better anticipate how to construct a all-weather portfolio that withstand shocks at times where fundamentals can really get neglected, and it can seem scary. But to the extent that you're able to look back and see some similarities, it does give you a little bit more comfort during those times where a lot of reasoning just goes out the window temporarily.
And is one of the takeaways, I mean, I just look at the progress of human history, is one of the takeaways that, everyone thinks this is the end of the world, but it's very unlikely not to be. So you shouldn't invest as if it's the end of the world. Is that a fair assessment of like of some of what you learned throughout this process?
Yeah, I think so, and I think there's also some misconceptions. Like when things are going really poorly, like some people would say, "Oh, don't invest in equities or something like that." But that's not really looking at the big picture. There's a lot more that goes into the thought process. Like I mean, I've studied various countries where the presidents have confiscated assets and such. Those things really have never been seen here in the United States in most people's lifetime, so they don't think about it. But you have to be aware that those things can happen, and I think it's always good to have a good element of diversification for those reasons.
I mean, I think that's a good segue to my next question, which is that one thing that your firm, Lafayette Investments, focuses on is keeping investors in the game. One way to get knocked out of the game is to get caught up in a mania. What is trying to help people avoid getting knocked out of the game look like from a practical standpoint?
Yeah, I think I touched on a little bit in the previous line of questioning, but I like to reference that a lot of people in the United States have really only ever known U.S. equities to go up at a pretty brisk pace over time, if like at least in this lifetime. In my book Markets in Chaos, I reference Japanese equities, which after a pretty epic blow up in the late 1980s, both equities and fixed income did effectively nothing for 3 decades. And I've been to countries such as Cuba, Zimbabwe, South Africa, where at various points those countries, the leader of those countries have confiscated assets. So I think it's important to really be aware that those types of things can happen. And my book, Markets in Chaos, has a chapter titled "How This Information Can Be Used." And I highlighted some practical things that I thought was important takeaways from studying these types of things. So some important lessons learned that I noted: do not attempt market timing, which people try to do. I've never seen anyone that's any good at it, and I wouldn't do that for anyone. Studying history can assist with evaluating risk factors, such as investing in businesses that require heavy leverage to earn a return. And there's various examples of banks that have blown up for any number of reasons, but it really goes back to that business model. Studying history can assist with analyzing the safety of particular investments. And I noted some of the capital intensive businesses that got into trouble during the COVID-19 crisis. And having a better appreciation for businesses with strong pricing power, because they can better push through price increases during times of high inflation. And I think it's important to at least have some element of country diversification, as I alluded to the example with Japan, which was a highly touted market in the 1980s before up until recently, both the equities and fixed income for over 30 years went nowhere. So I do think country diversification is important. And lastly, I noted asset class diversification because that can help mitigate risk of extended periods of weak performance within an asset class.
Great. That's a lot of helpful context. I'd like to step back a bit and talk about Lafayette's philosophy a bit. How would you describe the firm's approach to whether it's security selection or asset allocation, however you want to take that, but what is the general guiding light in terms of philosophy?
Yeah, when in terms of analyzing equities, I would say the approach is pretty similar to how Tom Gaynor of Markel Group generally describes his investment process, and that would be to look for companies with good returns on capital that are able to reinvest for growth. The business doesn't use too much leverage. Management has both talent and integrity, and the price is fair.
Got it. And maybe you could talk a little bit about the history of the firm and how that philosophy and approach was, kind of evolved and adopted over time.
Yeah, I mean, I think that just looking at companies like Berkshire Hathaway that we've owned for a really long time has kind of guided that approach, and looking at the types of things that like Warren Buffett has typically invested in over the years. I think that that's also helped guide the investment philosophy as well.
Got it. A lot of always a fan of Markel and Berkshire on this podcast. And kind of dovetailing that is that many of our prior guests and talk about investing in high quality businesses. You talked a little bit about the businesses that you gravitate towards, but how does maybe how do you distinguish between a high quality and a low quality business typically?
I think we have some guardrails that we look at when we're looking at assessing in terms of business quality, and some would be high return on capital. Like we often look for companies with 25, 30% and above. That's a pretty decent guardrail to meet, because there aren't many that are able to do that like across a market cycle. Solid levels of growth, because high returns don't do you anything if you can't then take it and invest it for growth. So we're usually looking at double-digit free cash flow growth coupled with respectable revenue growth. Usually low levels of capital intensity and relatively low levels of fixed costs. The companies are conservatively financed, and the businesses do not rely on the use of high levels of leverage to magnify returns. And I noted the point about banks and things like that earn, like say, 1 to 2% on assets and then pile on a lot of leverage. So we're not looking for those types of situations. Companies are shareholder friendly. Like we're looking for typically companies that have high rate of dividend growth or a nice share repurchase track record. And the company has demonstrated an ability to defend its high returns across different market cycles. We've seen a number of times where a company will look good, based on some factor that may temporarily be happening, but how have they done when there's low interest rates, when there's higher interest rates, those types of things. And the companies that we target often have pretty decent profit margins.
Got it. Thank you for that thorough response. One of my favorite questions to ask people, especially those who focus on quality businesses, is why would a business like that ever be undervalued? So I'd love to hear a little bit about like the situations that arise where you can find a company that has all of those qualities, but yet has trades at a discount to intrinsic value.
I think we've seen a number of situations where there was like a temporary slowdown in growth, because I think more and more, like especially with computer trading and such, people then tend to model that out in perpetuity. Like it, every decent growth company, there comes a time where there's a period of maturation where you go from this hyper growth phase to a more mature business. And it's always a question of, is is a company done growing, which usually doesn't happen if it actually is, if you're right and it's a really good company. So usually there's a slowdown for any number of reasons, and then it'll continue on from there. But that's usually the period where you go from a really high multiple down to something more reasonable.
Got it. And would you say that you have a watch list or a universe of companies that you would like to own, and that you kind of wait for those situations where a company would fall into, yeah, it goes from a hyper growth to just normal growth, or it goes from fast growth to more reasonable growth, and that's the opportunity set, and you've already done the work so that you can kind of act quickly, or is it not quite that structured?
Yeah, at any given time, I think we'll have like an investable universe of maybe 30 or 40 companies that we're actively doing research on. And we're always monitoring those companies to see what they're doing. A number of them recently, the prices have just been too high. I think that especially with where interest rates are now. So a number of them, I think, are still a decent way off from a price perspective. So yeah, that would be the overall philosophy.
You've also discussed the importance of management, and it appears that Lafayette is deeply concerned with how management treats its shareholders. So I'm curious that in your view, what does good treatment typically look like?
The primary focus, I think, in terms of treatment would be on capital allocation, which we'll get into next. But there's also a more intangible consideration, and I think that that has to do with trust. And I have learned that that over time, certain things that management does as it relates to the more tangible things make it more likely that it can be trusted. And a few examples: if a company uses a modest amount of leverage, I think that that makes them more likely to be trusted. That's not like the only consideration, but if you're, say, on the more extreme end, a criminal, you want to use other people's money. So they're not going to use equity because that would be using their own money. So they're going to use a high amount of leverage. So if a company is using a lot of leverage, it does make it more likely that you're going to run into one of those situations. So we're going to be more likely to trust a company that is conservatively financed. And building on that a bit, look for conservative accounting. Like, I always think if management is trying to cut corners on the numbers, what else are they, behind the scenes trying to cut corners on? I think I've seen a number of situations where at least from what I've seen, there's been a clear correlation with that. And also look for large payouts to shareholders, because company acting in their own self-interest will do things like pay huge excessive compensation instead of paying, growing the dividend over time or something like that. It's like a natural guardrail. Trust between a company and shareholder can include a wide range of things, but I also wanted to touch upon a recent example. I won't mention the stock, but I recently sold out of a stock after their investor day. They noted one of their core assumptions was accelerating growth over the medium term. There was a decent amount of this assumption was they were banking on a better economy. Like, well, I think the economy the past few years has been pretty decent. So like that to me suggested that they were pretty aggressive, which I already thought that their accounting was pretty aggressive. So then you get to thinking, like, if they're sharing these aggressive assumptions externally, like what's going on internally? You can't imagine that. So that's just a recent example I wanted to bring.
And you mentioned capital allocation and how important that is to you. And, I've always, I've thought a lot about how to assess capital allocation. And, one thing that's true about it is there's no, just one formula that you can say, like, these people know what they're doing versus not. So I'm curious about your process for assessing and evaluating capital allocation.
Yeah, look at what a company has done with their cash flow over time. Like, and just from a high level thinking, has this created value for shareholders? Now, we can run through a few bullet points on that, and it it doesn't do a shareholder any good if a company produces this nice fountain of cash and then they go and do something dumb with it. So I think this is really important. So does the company pay a dividend, and what is the dividend track record over time? To what degree has the company reduced share count over the long term? To the extent the company has made acquisitions of size, have these acquisitions created value for shareholders? And then when it comes to investing organically in the business? Has the company made sensible investments? So those would be a few of the most important things.
And I get the sense that you have a certain disdain for the value and growth labels that get applied to firms and strategies. I see you smiling. So where does that emanate from, and how does that, if at all, how does it influence the way you talk about your strategies?
Yeah, I think that in general, this discussion is baffling because I just look at I compare it to real life. Like in terms of the value received, I on a wide variety of consumer purchases in my real life, I have not only received high value from things that cost like low dollar points. Like that would be like the everyday equivalent of saying that only my best purchases have come at the dollar store. Like that's like how a comparison I would make. Now some have come at, there have been things that I've purchased at low price points that have created a lot of value, but there's also some things where that's not the case. And as a real life example, I'm astonished that $1,000 to $1,500 can get you a good TV. Like that can get you a 75 to 85 inch TV in some cases, and that's cheaper than a laptop, which to me is astonishing. And another real world example, I recently went to Antarctica, which was fabulous, and it carried a high price tag from nominal dollar terms, but Antarctica can't be replicated. There's no other place in the world like it. So I felt I got good value for my money, even though it was a high dollar value item. And I think of this like investing. Like I'm really just trying to assess what value am I getting for my money, and not only fishing in one pond. It doesn't really make sense to me. Like investments are relatively high PE or price to cash flow multiple. It doesn't always equate to being expensive. It may be the case, but sometimes like in life, you get what you pay for. That's been my experience.
And with that in mind, when you think about how that influences portfolio construction, I mean, do you have a basket of things that would fit more in traditional value and a basket of things that fit in traditional growth? And you kind of like some dollar store assets and some, luxury handbags. I mean, how does that mentality influence the way that, if someone was looking at the portfolio, how it's been put together?
Yeah, I think that an average portfolio would include some assets in both buckets. But if you were looking at the portfolio, you wouldn't say that this is a value portfolio or a growth portfolio. I bring it back to the assessment of quality that I touched upon earlier, but not companies that meet those guardrails will probably skew a little bit more towards what people would consider to be growth, but not always. I mean, there's some consumer goods companies that that wouldn't fit like the necessarily what most people would think of as a growth company, but I'd still consider it a good company. So I think that it would have both.
And you mentioned that Markel is kind of has given this firm a fair amount of guiding light in terms of how it invests, and as well as Berkshire. When I think about those firms, I think of being very long term, focused on compounding, focused on not obviously Buffett's own American Express and Coca-Cola for decades, right? So I'm just getting a sense of how what does a traditional hold period look like for you? And like what? Give me some typical reasons aside from what you already mentioned about aggressive accounting and assumptions. Like what are typical reasons why something gets sold out of the portfolio?
Yeah, a typical holding period can last hopefully over 10 years and often decade. I mean, Berkshire's been held for a very long time, and a lot of companies at the firm are held for very long periods. I mean, a lot of it has to do with we're targeting high quality companies, so that with the idea that we can defer taxes for longer and things like that. In general, our clients and myself included, we don't like to pay taxes. So to the extent that we can delay that as long as possible, we do. I would say the most common reason for selling is where something has gone wrong. Whether I mean, sometimes what can be a good company for a long time just isn't anymore. That could be to structural shifts in the industry that go against them. Maybe the management has suddenly started making huge acquisitions that doesn't make any sense. Things of that nature. Really, almost never do we say, "Oh, this stock is too expensive. We're going to exit the position," because we've learned that usually when that happens, it's difficult to get back in. So if it is a really good company, which I mean, we're only looking at like a basket of maybe 100 companies in the world. So if we think that this is going to continue to compound, we're not very rarely going to sell it because it's too expensive. It's usually because something has changed, whether it's in the industry, at the company level, management level, something like that.
In that response, you highlighted the valuation aspect. We haven't discussed that yet. Typically, what does a valuation process look like? Are you using DCFs, multiple analysis? Are you triangulating value? What does that process look like?
Yeah, using a number of evaluation factors. Don't focus nearly as much on PE as most people do. Mostly looking at strictly cash flow, because I think it's earnings do not always translate to cash, and I think that's a common misconception. And to the extent that it doesn't, well, you can't pay a dividend with earnings that aren't translating to cash. You can't acquire something, you can't invest. So it doesn't really make sense to me to look at earnings that aren't translating to cash. We'll look at like cash flow compared to say the growth over the last 10 years, projections over the next 5 years, and you have to take that with a grain of salt, because projections out even 1 year are often not that accurate. But we're looking at relatively predictable industries for the most part, so it does hold higher weight than it would if you're looking at lower quality businesses that are less predictable. And then we're looking at like the current price to cash flow multiple and things like that. So it's a summation of a lot of factors, and we usually look to we don't buy into a position all at once. Typically, we'll average in over maybe, I don't know, 3 or 4 quarters. I would say usually we're looking at the evaluation, saying this is in a reasonable range. We know we can't pick the exact spot landing that I don't think anyone knows, is this the exact bottom, but we'll say the sum of all these factors is reasonable, then we'll average in over a period of time, and that's typically the process.
As I think the way you're describing the companies you approach, it would seem to me that this portfolio would skew much larger relative to small. So what is that typically true, where it's mostly large and mega caps? Will you guys dive into smaller companies if you find something high quality? Maybe talk a little bit about that.
Yeah, I would say you're definitely correct. It does skew more large cap in mid cap. I think just because of the opportunity set that we've seen in recent years. I mean, do look at some in the small cap arena, but at least from what we've seen the past few years, there just have not been nearly as many companies in that universe that fit the guardrails that I discussed earlier. So to the extent that more companies are producing these high returns on capital and things like that within the small cap universe, there will be more, but that's just not what we've seen in the past few years. Maybe that'll change, but it's just based on what the opportunity set that we've seen.
I think this would be a great time to go into an example. So to the degree you're willing to discuss a current or past investment, I'd love to hear about an investment you think represents the quintessential Lafayette stock.
Okay. We've touched upon companies like Berkshire and Markel. I'm not going to use those as my example because I think everyone knows the Berkshire story, and Markel Group is another specialty insurer. And we have owned all of the, like, we've owned Alphabet, Microsoft, Apple, Meta, but people hear about those companies every day. So I'm not going to touch upon that. I would note a company that we've held for several years now, KLA Corporation, which some people may not be as familiar with. And KLA Corporation is a leading, it's a semiconductor company, and they're the leading player in the chip process control business. And the company provides process control services. They're essentially trying to they're helping make the process more efficient for companies such as Taiwan Semiconductor. And what's really nice about KLAC, that's their ticker symbol. What's really nice about their business is they have over 50% market share and 4 times the market share of its nearest competitor. So they have a somewhat of a monopoly in this structural growth business that's growing faster than the structurally attractive semiconductor market. And we talked about some of the consideration that we look for in quality earlier. So I'll just review those points. So high return on capital. KLA Corp has a full cycle return on capital around 30%. Solid levels of growth. They grew revenues at a 10-year CAGR well over 20% this past decade, with free cash flow well outstripping revenue growth. We look for companies usually have low levels of capital intensity and relatively low fixed costs. During the recent semiconductor downturn, KLAC was able to weather the storm because they have a servicing component that makes it more stable. Coupled with their flex, companies are usually conservatively debt position, and that's in spite of being very shareholder friendly. Over time, KLA Corp has grown the dividend at a 15% CAGR while significantly reducing share count. And the company is, we look for companies that demonstrated an ability to defend high returns for a long period of time. And KLA Corp has been around since 1975, and they've been able to navigate various semiconductor market cycles. And I noted, pretty high profit margins. KLA Corp has a net profit margin around 25%, which is quite high.
Interesting. Thank you for sharing that example. One thing that has been a headwind to a lot of public investors is this move to passive, and the idea that why wouldn't we just buy the S&P versus try to find people who are stock pickers. And my guess is some of your clients wrestle with that. But I'm curious, like, especially given the concentration we now see in the S&P 500, what guidance would you give someone who's considering throwing in the towel on active management?
Yeah, I think there's a few important points to point out there. The first being that a lot of people just look at what have various indices done over time and inherently assume that that's the return that they are going to earn in that vehicle. But in reality, that's not how it plays out. And I dug up a shocking example that I thought it was a study done by Fidelity Investments. Peter Lynch's Magellan Fund, which was one of the most successful funds of all time. earned an astonishing 29% return per year from 1977 to 1990. So you'd say if people were invested in this vehicle, they should have crushed it. Well, the average investor lost money in this fund over a period that this fund was earning 29% per year. And this is what happens a lot of time because of the human psychological component. Like, and this is translatable to what happens in a lot of indices. People, always say they're going to be long-term investors, but it usually doesn't turn out that way. They're buying and selling at the wrong times, and that negates a lot of the return. And another point you alluded to in your question or in your line of questioning about the construction of the S&P 500. Given the index weighting, the S&P 500 it has really become a play on a small collection of technology firms. I don't know how that will play out, but there's a pretty good argument to be made that something like an equal weighted index today, it really represents a more broadly diversified portfolio of assets. So it's really an interesting development, and we'll see how that plays out. But I don't think that the S&P 500, as it's currently constructed, as you kind of alluded to, is nearly as diversified as you would assume on the surface. I would also like to note, like, asset managers such as Lafayette Investments, like we and other firms provide other services in addition that people don't want to deal with. Even seemingly simple tasks like opening brokerage accounts, doing wire transfers. Like, a lot of people just don't want to deal with that, whether they're working or trying to enjoy retirement. And one final thing, I don't think a lot of people realize that even if you did dump all your money into an S&P 500 equivalent and maintain it for the long term, which often doesn't happen, history suggests that it isn't that simple. Like, what if we had a situation like Japan where the equity market did nothing for 30 years? Like, I don't know how people would react to that. I'm not predicting that that's the case, but it's certainly within the realm of possibility, and it needs to be considered. And I don't know, like, people here only know stocks to go up. So if that, to the extent that doesn't happen, there would be a big impact on human psychology there. And we can't rule out situations like what's happened in other places where the president decides to confiscate assets. To that extent, doesn't matter how good a business is. You would have to be shifting your money elsewhere. So I think there's a lot more to think about in terms of retirement planning than just simply saying I'm going to put money into an index and let it sit there.
And you mentioned asset managers offering other service to their investors. I know your firm helps clients allocate to fixed income as well. Now that rates have risen materially, what is the current Lafayette perspective on the role of fixed income securities in a portfolio?
Yeah, I think it depends on how old the person is, but particularly for like older retirees, I think there's a decent argument today that there should be more of an allocation to fixed income than there were at least a few years ago. I mean, for a while, shorter term rates were earning effectively nothing. Now, if you're an older retiree, you can earn over 5%. That's going to be, a decently attractive option, at least for some portion of the portfolio. And I know that we have retirees that are really happy with where rates are right now, especially after earning nothing for so long. So I think it depends on the situation, but certainly for at least some people, it's going to be a lot more attractive of a proposition today than it was a few years ago.
I think this would be a good time and a fun time to walk through a couple of the case studies from your book, Markets in Chaos. The one that seemed to resonate the most with me is the fact that, concerns about inflation and rising energy prices are present today, but that's not a new thing. And so I'm curious about how you would compare the current moment to the study you did of the 1970s energy crisis.
Yeah, and I'll begin by highlighting a few key differences between today and the 1970s. And for the first point being that global energy markets today look a lot different than they did back then because of the rise of shale. So the United States became and is a major energy player today because of the shale revolution, unlike back then. And the other key difference today is that government balance sheets are in much worse shape than they were at that time. The 1970s period was defined by stagflation, which people hadn't even heard of, or a lot of people hadn't even thought about it until recently. And stagflation, as a reminder, is a period of low growth and high inflation. And I don't think it would be surprising if we saw something similar to that develop. It'll be interesting to see how things play out, but it's certainly possible. And I think what will be really interesting to see is what happens during the next downturn, just because in the past we've sort of come to this standard playbook of these bailouts and stimulus, and with where debt is, domestically and abroad. How could that happen with the where the deficits are now without a huge without inflation going much higher? So that'll be something to watch. And I noted in 1973, and this is like deja vu, but Syria and Egypt attacked Israel in what would become known as the Yom Kippur War. And obviously, that is relevant to today with what's going on in the Middle East now. And those events are somewhat similar to what's happened in Ukraine in the past few years. And this was a little bit different, but between 1973 and 1974, the price per barrel of oil skyrocketed from 250 to 1150. Now, after the war in Ukraine started, we saw a decent jump in oil, but it wasn't anything like that. And I think that that's a decent amount of that is attributable, touched upon with how the oil market today is different. Like the U.S. Has been able to step in and provide some stability. OPEC isn't as influential as it once was. And just wanted to note one more point that's similar to the 1970s, and that has to do with labor unions. The strength of labor unions in the 1970s put upward pressure on inflation. And during that time, President Reagan launched a pretty well documented assault on labor unions, trying to get inflation under control. And many think that the 1980s was the period that led to the long-term decline of labor unions. And in the past few years, that's recently come back, and that has provided an upward pressure on inflation.
Interesting anecdotes. Thanks for sharing. I'd love to move to the one we're still living under, which is the aftermath of COVID and the crisis, the associated crisis. I'm curious if you see any parallels between what we're grappling with today and the events that occurred after the Spanish flu period in the 1920s.
Yeah. So I think it's important to recognize that throughout history, pandemics, there's always been a pre-pandemic world and a post-pandemic world. Like there's always been big changes, but these changes, the trends were already in place prior to the pandemic, and then they were just accelerated afterwards. And we've seen that happen since COVID-19. I'm actually going to provide I'm going to provide a couple bullet points about the Black Death instead of the Spanish flu, just because it was a little bit or a lot more profound. It was actually stunning, the impact that it had. Because the Black Death in the mid 1300s is estimated to have killed between 30 and 60% of all Europeans and between 75 and 200 million people globally at a time when the world population was just 475 million. And it took 150 to 200 years for the global population to recover from the Black Death, which is just really difficult to comprehend. And the Black Death helped ensure the demise of the Mongol Empire, which was they were the global power for the period leading up to the Black Death, and it led to the rise of China and some countries in the West, such as Spain, Portugal, and Britain. And there were lasting effects from the Black Death, such as bargaining power shifting to workers, and so many people died from the Black Death that there was a massive worker shortage. So that those are just really interesting things. And as it relates to COVID-19, some of the trends that were already in place prior to COVID that have now been accelerated. These include one of them being hybrid work. It's unclear as to what how permanent some of it will be, but I think that for at least some portion of the population, it's here to stay. And this development has knock-on effects for industries such as office demand, and laterally companies that provide loans to offices and things of that nature. And COVID-19, I think, definitely accelerated digitization. I mean, we already had the long-term trends of the shift from cash to electronic payments, mobile ordering to digital, things like that. But those trends were put into overdrive, and that's continued in the post-COVID world. And the other long-term effect from COVID has been on government balance sheets. In the wake of the COVID-19 crisis, the IMF reported that half of the world's countries reported a bailout, which is pretty shocking. That's pretty crazy. So government balance sheets definitely declined in the wake of COVID-19.
And as an investor, it's kind of important to remember that history doesn't repeat, but it may rhyme. So when I think about your deep knowledge of these prior crises, it can certainly inform your investing approach. But I guess I'm curious about how you go about avoiding allowing your expertise to make you maybe gun shy or concerned. Like, you're just so deeply knowledgeable about what can go wrong, and how people can lose money. How do you avoid that impacting how you invest today?
Yeah, I think it's certainly a valid question, but I think that looking at history helps me avoid common investment misconceptions, such as any one country's equity market being a foolproof investment, and viewing cash equivalents as a risk-free investment, which isn't the case, and things like that. I definitely think it helps. And looking at markets today, I think it's appropriate to have a heightened sense of caution, like given global debt levels, wars going on, things of that nature. But that doesn't mean, like, I don't think there's any time, regardless of what's going on, that you shouldn't have some allocation to equities. Like that just doesn't make sense to me. In studying history, I think you become more aware of risks, such as what can happen with like a given country's government debt, like which can be eliminated. We've seen that happen a lot of times in history, and I don't think that that can be ruled out in the future.
And I never want to leave a discussion with a manager without talking about mistakes. Is there an investment mistake that was so profound that it has forever changed the way you make decisions?
Yeah, I think I'll just touch upon something that I learned from the COVID-19 crisis. And just looking at how things developed there, I got a much stronger appreciation for businesses with relatively flexible cost structures. And what I've seen during times of turmoil, it can be very difficult for businesses to be able to have a flexible cost structure. This is because if a business sees their revenues plummet, like during COVID-19, it was especially profound. If they can't adjust their expenses quickly, they can go from being nicely profitable to posting huge losses in a short period of time. And we saw that during COVID-19, especially with some companies like in airlines, cruise lines that were decimated, but those companies also they have relatively high fixed cost base compared to some other businesses. So definitely a lot more on guard for those types of situations as a result of that.
And some people would argue that those businesses um, may trade at a discount because of that, and the price can make up for that structural lack of the kind of inflexibility. Is there any situation in your mind where price can make up for that, or is this kind of like it's more like you're going to, for your personal investing style, you're going to draw a line in the sand where you just don't want to invest in businesses that have that much operating leverage?
Yeah, I think most cases it would be the latter to what you're alluding to. I think that like as a result that would fall into a bucket that Warren Buffett would say that's too hard. It just is outside the core competency.
So if we're having this conversation again in 7 years, I'm curious about what success would look like to you personally, and then maybe, and any comments about how Lafayette, what that looks like to Lafayette as well.
Yeah, I think on a personal level, it would mean that I would be happy in a sustainable fashion. And this would mean that I maintain happiness through a balance of short-term and long-term trade-offs when it comes to things like professional success, personal relationships, finances, and personal health. And I think success at the firm level would be that we continue to take care of our clients, because to the extent that we do continue to make our clients happy, more business will come in the door, or our assets will take care of themselves. But I've definitely learned that if you just do a good job for your current client base, make them happy, business just comes around. So to the extent that that continues to be the case, I think that we'll be in that place 7 years from now.
And before I hand it off to you to talk about where people can learn more about you, we'll close with the question we ask all of our manager guests. What is the most underappreciated aspect of the investment opportunity set that's in front of Lafayette today?
Yeah, I think it's that one of the jobs of investment advisors is that we have to worry about things that a lot of people don't want to worry about. Like I think that there will continue to be demand for people outsourcing the worrying component to investment advisors, like in firms like Lafayette, and I think that is going to be something that persists well into the future.
Can you give an example? I'm curious about what you think you're like compensated for worrying about that other people would love to outsource.
I mean, I think it's just everything that goes into a retirement portfolio. For example, I think that if you aren't looking at your assets on a daily basis, and you're trying to figure out, should I have X allocation to fixed income, X allocation to equities, is this the time to sell this particular asset? I think that there's always going to be demand for monitoring those types of things. Like a lot of retirees just don't want to think about it. They want to enjoy their retirement, and people that are working on a daily basis, they don't have time to look at this type of stuff. So to the extent that someone like myself is doing something like this full time, I think that there will continue to be demand for that.
Well, Brendan, it's been great to learn about your firm and the books you've written. Where can people reach you if they want to learn more?
Yeah, you can find me on LinkedIn, Brendan Hughes, CFA, Lafayette Investments. If you just put that in search, it'll come up. And you can also reach me at you can send me an email. My personal email is hughes2525@gmail.com. So you can reach me through those avenues, and look forward to hearing from you.
And I have to ask, is there another book in your future, or is that,
Uh,
your main focus now is investing, and we'll see, we'll see if there's a book at some point.
yeah, nothing is in the pipeline at this juncture, but in the future, I think that there will be.
Well, Brendan, thanks again for being on Compounders. Really enjoyed this discussion.
Thanks a lot, Ben. Really appreciated you having me on the show today, and thought it was a blast.